In every market cycle, there's a hot thing. .com stocks, crypto tokens, AI tools, real estate booms. And every cycle creates the same illusion. If I move fast enough, I can catch the wave. But here's the uncomfortable truth. If you can see the wave clearly, you're already late. Because waves aren't caught by chasers. They're ridden by those who were already in position. The greatest companies weren't built by trend hunters. They were built by missionaries. People obsessed with solving a problem long before it became fashionable. Missionaries endure boredom. Mercenaries endure only momentum. Mercenaries build to flip. Missionaries build to matter. And markets reward those who can survive the boring years. Because before scale, there's silence. Before profit, there's patience. Before dominance, there's doubt. Passion is not a motivational phrase. It's a durability mechanism. When you truly care, you stay. When you stay, you compound. When you compound, you win. And compounding beats hype. Every time. Markets punish emotional chasing. Retail investors pile into trends. Founders pivot toward whatever VCs are funding. Employees jump into whatever sector is booming. But capital flows to conviction. The highest returns don't come from chasing heat. They come from positioning early and holding through boredom. Missionaries outperform mercenaries because they reinvest instead of extracting. They optimize for product, not exit. They think in decades, not quarters. Passion isn't emotional. It's strategic. Because passion increases staying power. Staying power increases skill. Skill increases defensibility. Defensibility creates asymmetric upside. That's how real wealth compounds. Not through chasing, but through positioning. There are two types of builders in every economic cycle. The first builds because they believe. The second builds because the market pays. Both can become wealthy. Only one builds something that survives winter. This is not a moral argument. It's a capital allocation argument. Because money behaves differently depending on who controls it. And markets eventually expose the difference. Capital is emotional before it is rational. In expansions, investors chase acceleration. In contractions, they rediscover durability. When liquidity is abundant, the mercenary thrives. When liquidity tightens, only conviction survives. The difference between positioning and chasing trends begins here, in time horizon. Missionaries optimize for decades. Mercenaries optimize for quarters. And markets reward each, temporarily. Every major wealth cycle begins quietly. Cloud computing, electric vehicles, artificial intelligence, e-commerce. Before headlines, there were years of obscurity. Before retail excitement, there were losses. Capital at this stage is patient, skeptical, and rare. This is positioning. Then momentum appears. Revenue growth accelerates. User adoption curves steepen. Valuations detach from fundamentals. Suddenly, the narrative is obvious. And when something feels obvious, money floods in. But this capital is different. It isn't patient. It is opportunistic. It is chasing the visible wave, not preparing for the next one. Amazon lost money for years. Investors questioned leadership. Analysts criticized margins. But internally, infrastructure expanded. Logistics, fulfillment centers, data capabilities. Capital wasn't extracted. It was reinvested. Tesla survived near bankruptcy more than once. For over a decade, it was dismissed as overvalued fantasy. Yet factories were built, supply chains secured, battery innovation refined. NVIDIA spent years developing GPU architecture for use cases the market barely understood. Gaming funded R&D. AI wasn't yet mainstream. This is what positioning looks like. You build before demand becomes obvious. Missionary companies share one trait: negative cash flow periods. They absorb criticism. Their stock stagnates. Capital raises dilute early holders. But something critical happens during struggle. Weak capital exits. Short-term investors sell. Only aligned shareholders remain. This alignment is invisible, but powerful. Once traction becomes visible, a second wave of capital arrives. Hedge funds, momentum traders, speculators. The narrative shifts from "will this survive" to "how high can this go?" Valuation expands faster than revenue. Multiples stretch. And leadership faces temptation. Do we optimize for the stock price, or do we continue reinvesting? Every great company faces this decision: monetize aggressively now, or reinvest aggressively for later. Amazon chose logistics over short-term profit. Tesla chose manufacturing scale over quarterly comfort. NVIDIA chose research over dividends. That decision determines whether the company compounds or peaks. Investors who understand this turning point accumulate during discomfort, not during euphoria.
To our success
and to many more.
Cheers.
Inflection points are misunderstood in real time. AI seemed incremental until it wasn't. Cloud computing seemed niche until it wasn't. When positioning meets timing, earnings explode. And suddenly, the missionary looks like a genius. But the financial truth is quieter. They absorbed a decade of volatility first. When infrastructure is already built, growth becomes explosive. Operating leverage kicks in. Fixed costs spread across accelerating revenue. Margins expand rapidly. Institutional capital reallocates. Pension funds, sovereign wealth, long-duration portfolios. Now the narrative is validated, but by this stage, most of the asymmetric return has already occurred. At the top of cycles, something predictable happens. Copycats multiply. SPACs promise shortcuts. Meme stocks detach from earnings. Tokens launch without utility. Liquidity creates illusion. In these phases, mercenaries outperform. Fast money wins, but only while momentum persists. When growth slows, cost structures remain. Companies overhire. They overextend leverage. They issue equity aggressively at peak prices. When growth slows, cost structures remain. Balance sheets weaken, and dilution becomes permanent. The market does not forgive capital misallocation. Normalization always arrives. Demand stabilizes. Interest rates rise. Liquidity tightens. Valuations compress. Speculative capital exits instantly. Missionary companies retrench, but survive. Mercenary companies disappear. When cycles turn, disciplined builders cut costs, not vision. They preserve core R&D. They streamline operations. They extend runway. Because they were never building for this quarter. They were building for inevitability. Winter becomes a competitive advantage. Weaker players die. Talent becomes available. Assets become discounted. Retail investors often enter at emotional peaks. Fear of missing out overrides analysis. Price becomes validation. But long-term wealth is built through time horizon arbitrage. Buying when narratives are fragile. Holding when headlines are hostile. Missionary investing requires boredom tolerance. Mercenary investing requires timing precision. One compounds. The other trades volatility. Chasing trends feels productive. You are in motion. You are reacting. You are participating. Positioning feels slow. You are early. You are uncertain. You are misunderstood. But positioning places you where the wave will eventually crash. Chasing requires predicting its height. Only one requires less precision. In every major cycle, the largest fortunes were built through ownership, not trading. Early Amazon shareholders, Tesla believers during drawdowns, Nvidia holders before AI dominance. The majority of returns came from multiple expansion after earnings power materialized, not from flipping headlines. Compounding is mathematically violent over long durations, but it demands emotional stability. Impatience destroys positioning. Investors rotate too early. Founders pivot too often. Capital gets redeployed before thesis maturity. The opportunity cost is invisible, but it compounds negatively. The difference between 10 times and 2 times is often just time held. Every emerging sector today, AI infrastructure, energy transition, advanced manufacturing, contains both missionaries and mercenaries. Some are building real capacity. Others are riding narrative velocity. The distinction will not be obvious in real time. It never is. But balance sheets reveal intent. Capital allocation reveals conviction. Reinvestment patterns reveal horizon. Markets are not moral. They reward alignment between vision and capital discipline. Missionaries without financial rigor fail. Mercenaries without durability fade. The optimal strategy is not blind passion. It is disciplined conviction. Build where you have structural understanding. Accumulate where infrastructure precedes hype. Hold through volatility if fundamentals compound. Position before the wave. Because once the wave is visible, it is already crowded. And crowded trades rarely build empires. If this changed how you see money, subscribe. These documentaries are built for thinkers, not spectators. And if you're serious about mastering capital, watch the next video on your screen.